spend 15-20 minutes talking about this. I can't obviously don't have time to go into a lot of detail on them, but I do want to just cover them so for folks who are maybe familiar with them but not really too deeply, or somebody who doesn't know about them, I'll show you what they are. So first thing I'm going to show you is an option chain, and most everybody here probably knows about an option chain. This is Bristol Myers. This is what an option chain looks like. When you look at an option chain, everything on the left here is these are the calls and these are puts. All right, so the calls are over here, the puts are over here. This is the strike price. So this is what the strike price would be. You see it goes up here in increments of $1 for the most part, well 50 cents actually. This is Bristol Myers. And over here you have the bid and the ask. This tells you what somebody's bidding for this. So if you look at the 56 calls, for example, they were bidding 6 cents and somebody was asking 14 cents. This is the spread. So this is what you're trying to get in between when you take something that. If you were trying to buy it, you try to buy it for as low as possible, between 6 and 14. If you're trying to sell it, you're trying to sell it for as high as possible. Now, the one other number here is called the delta. And you see this delta, that's in the white number right here. Right now, if you look at the strike, the price here was 53.79. So about close, 54 was pretty close to the at the money price, was called at the money, which is what that strike was. You see that the delta here is 52 on this $54 call. So it's $52, 52 delta, which is, and I'll go over what delta is. But as you move into the money, you notice the 54s, the 53s, the 52s. These are in the money. The stock is above those price. You see the delta gets bigger and bigger, and as you move away from the at the money, the delta gets smaller and smaller. If you look at it over here, you notice you add up the delta on the call and the delta on the put. It comes miraculously comes to 100. It's always going to come out to 1. So this tells you what the delta is on Bristol Myers. Okay, so those are what you're looking for. That's the information you want. The strike price. These are the expiration dates here. They're always this is in weekly. So every week, every Friday, there's another expiration date. So if you move across these and click on them, you're going to get the different prices for those that particular stock. Now, there's one other thing here on the option chain. This is another screen. What I've included in here is the volume and the open interest. It's over here. See, this says OI is open interest, V is volume. That the open interest is how many contracts are outstanding right now on Bristol Myers for this strike price on this date. All right, so for March 15th, and this is old, obviously, we had 617 contracts traded today, and the open interest was 11,867. So this is how many traded today. This is how many contracts there were at the beginning of the day. Open interest always includes all the contracts that were available when the market opened, but it does not include the contracts that have been added today. That's why you have two separate numbers. At the end of the day, they'll create a different open interest. It'll be all the options that are still open at the end of the day. Right, so that's open interest and volume. And this is kind of important because you want the volume to be heavy enough so that when you get into a trade, you're able to get out of it okay. The more open interest there is, the easier it is to exit a trade. All right, so that's an option chain. Calls over here, puts over here, and the rest of the information is that you're interested in is usually delta and open interest and volume. All right, so we're going to talk about options here. Now, I don't want to be too confusing here, but I just want to go over some basics. We're going to talk about options, what makes up the premium. I want to explain intrinsic versus extrinsic value. We're going to cover some of the Greeks. I'm not going to go into really deep diving into Greeks. We're going to cover the ones that I feel like are important. Strike price and expiration dates, which ones to take. Volume and open interest, we talked about that already. Primary option trades that we use. And we're going to talk about which option strategies are bullish, which are bearish, which are neutral, and what setups to use for these particular things. It's important to know what option strategies to use if the market's bullish, if it's bearish, or if it's neutral. There's different option strategies for each one of these setups. All right, so what are options? Okay, well, a lot of people think options are just like buying stock. They're not like buying stock. They come options come with what's called rights and obligations. You can buy them or you can sell them. Right, so if you're buying a call or a put, you're long a call or a put. So in other words, you're buying a call, you're expecting the market to go up. If you're buying a put, you're expecting the price to go down. You can sell them. You can sell, when you sell one, you're short a call or short a put. So if you sell a call, you're expecting the market to go down. And when you sell a put, you're expecting the market to go up because you're going to collect premium when you sell those things. And by the way, selling puts or selling calls, especially naked when you don't have a spread on, should never be done. Selling puts only if you really want to own that stock at a lower price. So again, buying a call is bullish, selling a call is bearish. Buying a put is bearish, selling a put is bullish. This is how these options work. Now remember, they're made up of several different things besides just stock price. All right, so what makes up an option price? This is important because when you buy a stock, you're paying a price for it. That's what it costs you. If you buy Microsoft at 100, it's $100. There's no time involved with it. There's no time decay that comes with it. None of that stuff. There is some volatility in the price, but that's built into the stock price. So basically, options can be either at the money. So if you buy, if Microsoft's 100 and you buy a $100 call or a $100 put, that's an at the money option because it's the strike price is exactly what the stock's trading for, or close to what the stock's trading for. You can have it in the money. If Microsoft is trading at 100 and you buy a $95 call, that's an in the money call because the stock is $5 higher than that call. And if you buy a $105 call when Microsoft's trading at 100, that's an out of the money call. That means the stock has got to move up $5 just to get to your strike price, right? So that's what at the money, in the money, and out of the money mean. And this is important because there's the way you buy options, there's certain ones you should be buying and certain ones you shouldn't be buying. So what makes up the option premium price? When you pay for an option, what's it include? Obviously, it's going to include the stock price. So again, back to the Microsoft trading at $100. All right, if I buy a $95 call in Microsoft and the stock's trading at 100, then if I'm buying a $95 call, that call has some value, right? It's got what's called intrinsic value. The intrinsic value is the difference between the strike that I took and what the stock's trading at. So if I took a $95 call and the stock's trading at 100, I have $5 of intrinsic value. In other words, that option is worth $5 just because the stock price is $5 higher than that. That's called intrinsic value. All right. So no matter what, I'm going to have $5 of value in that stock as long as Microsoft stays at 100. The next thing is what's called implied volatility. The implied volatility is extra premium that's added to the option price based on what the market makers think, how fast they think that stock's going to move, how much volatility is in their stock, how much is it moving up and down in a day, in a week. That's implied volatility. So they jack up the price of the premiums, they add implied volatility to it. And then the last thing is time decay. Time decay is how much time is there between now and the option's expiration. So if I have like a $100 Microsoft call that expires in 4 weeks, the time decay is relatively slow because I've got a lot of time until that option expires. If I've got a Microsoft $100 call and now there's only a week until it expires, the time decay is going to be very, very fast because the amount of time for that stock to move has been reduced by a lot. So the time decay that's going to be built into that premium is coming out of there. So those are the things that make up your basically make up an option price. There are a few other things. There's a thing called Black-Scholes. I'm not going to get into that. All right, so that's what makes up an option price. So again, to compare intrinsic to extrinsic value, and this is really kind of important. We're going to use, in this particular case, we're going to use a $50 option at a stock trading at $55. All right, so a $50 option at a stock trading at $55. Well, obviously the option is worth at least $5 more than the $50 that you're getting because the stock is already at 55. So it has an intrinsic value of $5. So when you look at the option price, it might say, you know, $5.75 or $6. If that's the case, then you've got $5 of intrinsic value built into that premium. All right. Now the extrinsic value is the option value. So if let's say we paid $6 and the stock's trading at 55. We bought a 50 option. We've got an extra $1 we're paying for that above what the intrinsic value is. That's the extrinsic value. And that's all you have to do is just subtract the option value minus the intrinsic value, and that gives you what your extrinsic value is. And you want to pay as little extrinsic value as you can, because that's not part of the intrinsic value. That means that particular portion of the option price is going to be impacted by time decay and volatility changes. All right. So again, it's also important that the volume of options trade the strike price and expiration date as well. We talked about that for open interest. But when I buy an option, I'm going to take a delta of about 65 to 75. I want that stock to move pretty good, which means any option I take when I enter a trade is going to be in the money. They're always going to be in the money. I'm going to have some intrinsic value in that trade, in that option. Now the Greeks, I'm just going to cover these three: the delta, theta, and the gamma. The delta, okay, the delta, we talked about that, what you saw on the option chart, right? The delta will tell you how much the option price moves in relation to a stock price. So if the stock price moves $1 and you have a delta of 50, it means the option is going to go up 50 cents. So when I take a delta of 70 on the stock, for example, if the stock moves $1, my option price is going to go up 70 cents. That's what delta is. It's basically how much the option price moves relative to how much the stock price moves. The theta is the time decay. This is the decrease in value of the options as the expiration date approaches. As you get closer and closer to expiration, this time decay is going to come out of that option price, and it's going to cut down on the value of the option. And the last thing is gamma. This is the rate of change in delta. If you've got a stock that's really, really volatile, let's say the delta is 70, and the stock all of a sudden takes off with really big green candles, the delta can go from 70 to 80 really quickly, because the gamma is the rate of change in delta. And if the stock's moving up fast, it's going to move, the delta is going to move up fast. And this means when the gamma is high, it means the option price can trade dramatically with only a small price change in the stock. Now, I use an example here. If you have a stock that all of a sudden a news event comes out and the stock shoots up from $20 to $27 in 10 minutes, all right, you're going to have a huge amount of gamma here, because the stock is ripping higher. The delta is going up really fast. And in this particular case, a lot of times the option can actually move faster than the stock price. So the option could go up $1.50 when the stock only goes up $1.25. All right, so it's the gamma that's causing that. Now, this is a double-edged sword, because when the stock price starts to level off after this big, huge run-up, the gamma is going to drop. The delta is going to drop. So the stock price, which maybe the option price ran up from $6 to $8, even though the stock is going sideways now, the option price is going to start coming down, because the gamma is reducing the delta. And it's a little tricky, but that's just something to be aware of. But if you've ever traded options on a stock that was moving really quickly, you might notice that the stock price wasn't even keeping up with the option price. The option was going up faster than the stock price. All right, so these are the primary option strategies. I don't use them all, but these are what the primary option strategies are. Obviously, long calls, long puts. Put credit spread or call credit spread. Anything that's a credit brings the money into your account. A put debit spread or a call debit spread, we talked about those. I do calendar spreads, which I call time spreads. That's a type of calendar spread that I use over earnings. Then there's condors, neutral trade, butterflies, strangles, and straddles. There's other ones, but this is most of the ones that they look at. I don't use any condors. I do butterflies, but I don't really call them out in the room. They're a little bit trickier for most people. But we do some strangles and some straddles. So those are the primary option strategies that I look at when I look at a trade to make a determination which way should I go on this. All right, so these are bullish and bearish and neutral option strategies. So if you like a stock long and you want to use an option strategy, here's what you can do. You can do a long call. You can do a short put to bring in premium. You can do a put credit spread to bring in premium, or you can do a call debit spread. Those are all bullish strategies using options. Bearish, you're gonna look the same as this. Short, you can short the calls. Never do this. You can take long puts. You can do a call credit spread or a put debit spread. All of these strategies are bearish. All right, so this is kind of a little breakdown. What are the neutral option strategies? Condors. Condors don't care which way the market moves. Straddles and strangles don't care. This condors is looking for a stock to stay kind of in a tight range. They don't really want a big move. Straddles and strangles are looking for a big move. They don't care what direction, but they want it to move big one way or the other. And then time spreads are a neutral strategy. This is done over earnings. We don't care which way the stock moves after earnings. We just want it to move within a relatively tight percentage up or down. All right, so these are the strategies that you can use once you've determined what a trade is. Because one of the thought processes you go through is, if you look at a stock and you like it long, then you have to decide, okay, what do I want to do? Do I want to buy the stock? Do I want to buy a call? Do I want to do a credit spread on it? Do I want to do a debit spread on it? There's a lot of things that go into this, and a lot of times I'm trying to find what's the best strategy for these things, because each one has advantages and disadvantages. Okay, so here's the setups, and again, I'm just going to go over these quickly. When you look at the video again, you can go over these and make sure. And I have videos on all of these. But a put credit spread, you're selling a put and buying a put at a lower strike price, and you receive a credit. A call credit spread, you're selling a call and buying a call at a higher strike price to receive a credit. A put debit spread, now this is debit, so it's going to cost you money. Buy a put and sell a put at a lower strike price for a debit. That's going to cost you a debit, all right? And that's a bearish strategy. And a call debit spread, buy a call and sell a call at a higher strike price for a debit. You're expecting the market to go up. You're expecting the stock to go down. Credit spread, you're expecting it to be neutral to bullish, and call credit spread, neutral to bearish. Calendar spread, this is what we do on time spread. We sell a put or a call at the near expiration date, this week's expiration, and buy a call or a put with a later expiration date out in time. So you've got you've basically got same strikes, different expiration dates. That's what a calendar spread is. And then the time spread I talked about, this is a specific calendar spread to use on earnings. We're selling this week's calls, for example, and buying next week's calls. And this is how we capture the time decay and the volatility crush. And a strangle, you're buying a call and buying a put one strike or more away from the money using the same expiration date. That's a strangle. So if you had $100, the stock was trading at 100, you'd buy a $101 call and a $99 put. All right, and that's how you would get. That's how you create a strangle. A straddle is the same thing, except if the stock's trading at 100, you're buying a 100 call and buying a 100 put. So that's a straddle. You're looking for the stock to move up big or down big enough to cover the cost of the call and the put that you bought. Strangles are cheaper to buy because they're out of the money already. Straddles are more expensive, but they can move better because the stock doesn't have to move as much to be in the money because you're already in the money. All right, so those are the option strategy setups. And choosing the best auction price, and you know, a lot of this depends. You've got to look at the option chain and kind of decide where you want to take the expiration date. But typically, when I'm taking a trade, I'm looking out, 3 to 4 weeks for my expiration date. I'm taking a strike price that's going to be in the money with a delta of about 65 to 75. 65 to 75 delta. So the strike price is going to be in the money and an expiration date 3 to 4 weeks out. This is general. This is generally what I'm looking at. I'm going to go through and look at expiration dates, try to find the best price for the option I want to take. And a lot of that depends on, what the bid-ask spread is, etc. So I may say, okay, I want to go 1 week further because I can get a better bang for my buck 1 week out further. But that's what you want to do. And I'm taking in the money calls or in the money puts. I'm always taking in the money calls, in the money puts with an expiration date, 3 to 4 weeks out generally, with a delta of 65 to 75 or so. All right, let's see if we got some questions here. How do you defend a credit spread if it goes against you? That's not a tough question, but it takes a little time to answer that. Typically, if you can leg out of a credit spread if you know how to do that, but it adds risk to your trade when you do that. So if you're short a call or short a put and you've got a longer put, you can actually buy back the short put and ride the long put down. But the market has to keep going in that direction, because if it reverses and goes against you, you end up losing more money. So for most people who are just doing credit spreads, the best thing to do is if it goes against you is just to exit the trade, take the loss. I generally think that options with higher deltas, 67, a better value out of money when with deltas around 50. Yes, I do. And I mean, the ones at the money have moved better, but the point is you have more intrinsic value in the money calls or in the money puts, which means if the stock starts to move against you a little bit, you're not losing as much value because a lot of your option price is intrinsic. In other words, it's built into the stock, the price of the stock. If you're at the money or out of the money, everything that you're paying for that particular option is being hit by time decay and volatility crush. You're losing money on the entire value of that premium that you took. When it's in the money, you're only losing value on just a small portion of it. Dennis, you're welcome. Does the service send credit spreads alerts of buying only? No, we send credit spreads alerts, debit spread alerts, time spread alerts, straight puts and straight calls. The only thing I don't send out right now yet is strangles. I'm going to be doing that pretty soon. But credit spreads, debit spreads, straight calls, straight puts, time spreads, I'll get alerted. Okay. All right. So that kind of wraps up earnings options. I didn't want to spend too long on this. Again, I could go on for a couple hours about this, but I kind of want to give you an idea to hopefully make people understand. I think one of the nicest things here is this, knowing what particular option strategies are available to you based on what your consensus is of what the stock's going to do. All right, so I'm going to show you now, this is going to show you the compass system. It's going to show you some of the trades we've taken lately, why we took them, how they worked out, etc. So you can see what we're looking at. All right, so this is Lulu. We just took this fairly recently. This was a put debit spread, and we took it overnight, not that long ago, in April, early April, I think. But this was the compass system here showing Lulu on a daily chart. All right, so where do we take the trade? Well, I took it right here, and if you see how the stock is compressing right here. This was earnings. See how it's compressing right here, and then you see how it breaks down here. The stock starts to break down, and notice that we went from a multi-time frame momentum from blue to yellow. That's bullish to bearish on multi-time frame. Now the current time frame momentum was bearish the whole time. So we got red and yellow here. This is a short setup. This is telling me the institutions are selling this thing. So we took it overnight and we entered for $1.92 and we get out the next morning for $3 a contract, 192 and out for $3. So it was 56% profit on that Lulu put debit spread. And we did a debit spread on this because it's cheaper to take a debit spread than it is to do straight puts. And it was a fairly expensive stock. So to buy straight puts on this thing would have cost in the neighborhood of about $2,200. We were able to get in for $1.92 or $192 on a debit spread. So this is one of the reasons I took that, because I wanted folks in the room to be able to, and folks in the alert service to be able to take the trade, but I don't want to tell them that it's going to be $2,000 a contract. So I took a debit spread in that particular case. This was Shake Shack. We were in 2-day trade here. This is another daily chart. Again, you look at here, can you tell the institutions are buying this thing? You can see this big gap up here in earnings moving sideways. You see how it's compressing. But we took it right here as it started to roll off of this little white line right here. And we took it long right here. Everything is telling us it's in there to be long. So we took it and we wrote it up. 26% profit in 2 days in this thing. And, it got to the high here and we get out. But we were only in this for 2 days, just up into here. But still, 26% is not bad. All right, this was workday. Now this was a little trickier, and I'll show you. This was the long-term trend. It was bullish. It went to yellow here, but it was mostly bullish. See the multi-time frame trend. You see how it was going yellow to blue. We had bullish, bearish, bullish, bearish, but it was switching here back over to bullish again, and I had current time frame momentum was good. So I was okay with taking this if I got a proper technical setup. Now this shaded area here on the compass system is called a dynamic compression zone. This is the compass system creates this compression zone when it sees a compression it can be identified when you break out of it, which is what we did right here. So that's what we took it, workday. We were in this for 5 days, and we rode this thing up for a 30% profit. And you see how it switched back to yellow here? This was one I had to watch. But my current time frame momentum, which was on the daily, stayed green, stayed bullish the whole time. So I felt comfortable with that trade. GCT, this is another one I actually just got in today. Again, but this was GCT. We took this 2-day trade for 26%. Everything's green or blue. Dynamic compression zone is coming out of dynamic compression, but it's still compressing here. We took it here in this pop, and 2 days and out. MDT, this was a 25% profit on a swing trade here. You see how this went yellow to blue? See how this train changed to blue right here where everything else was green? I knew the current time frame momentum on the daily had gone to institutions buying. Bought it right here and rode this thing up, 25% profit on a swing trade right here on MDT. Just so you can see what the compass system looks like. This is Vertex, same thing. Again, this is what we're looking for. This is telling you that the stock is bullish. If this was yellow and red, even though it popped up, you wouldn't be interested in something like this, right? But it popped up. We made 30% in 3 days on this thing, and a pretty nice trade. And you can see how it's all of a sudden shifted to mixed over here. This was McDonald's, $8.30 in, out for 11.30, just overnight with $3 profit per contract, 37% gain. Notice everything's green. And now the stock is moving sideways. The institutions are buying it, but the price is not moving yet. But here we get this breakout of this dynamic compression zone. The institutions are buying it. We can see that. So we buy it here. We're in overnight, and we get out right here on just this one candle. Okay. Proud, same thing. And I won't go on too long about these because they're gonna look. One of them is gonna look the same. This was Amazon. Same thing here. We get the institutions buying. We did have a long-term trend that was neutral, kind of, but we like this break and this pop out of the box signal. We took that. All right. So I'll just rip through these. This was ENPH compression, break to the downside on a pop out of the box symbol, 20% in an hour. This is a 5-minute chart. We were in this for an hour for 20%. Institutions selling the heck out of this thing. All right, and Verizon, 50%. This was a nice one. We get into this for 45 cents. Verizon is inexpensive for the options. $45 for a put, even though it's in the money. I think we're just out 2 weeks on this, but this we got 50%. We get in at 45 cents, out at 67 cents. So in at 40. Took 10 contracts. It was $450. An hour later, you get out for $670 on Verizon. Obviously, the institutions are selling the heck out of this thing. And this is just a SPY super system setup that I told you about. Again, you can see here that the system, we're getting a pop out of the box signal. Everything is bearish. Get in here, and we get out right here. Just a very short trade. These are 5-minute candlesticks here. And this was a Tesla trade we took overnight. We had on the 5-minute chart, we had a pop out of the box signal here at the close of the day. Everything was red. The institutions were selling. We decided to take a chance and take a put overnight, and it dropped from $120 to $112. Big explosion in the options. They rocketed up. Now these all look good, and you have to understand that we don't win every single trade. It's important to understand that there's always going to be losses. Everybody has losses. We have losses. I'm not doing 100% win rate. I'm doing more like 85 to 90% win rate. So there are losses. All right, let me just check the questions here. When a trade doesn't work, is it usually a common reason? News, signals, conflict. You know, there's some, Christina, there's some reasons for them. Sometimes there's just, there's just no reason for it. Yeah, news will do it for you. News will, any kind of news event, which would be like off earnings or something, that takes over any kind of technicals. But news will do it. Signal conflict, not necessarily. And listen, a lot of times it's just that the institutions have changed their opinion on the stock, and it'll reverse on you. Where in the compass screen indicate institutional involvement? It's basically the combination of the colors, John. If you're looking at the colors, if it's all green or blue, or all red or all yellow, all green or blue is bullish, all red or yellow is bearish, because it's using multiple indicators to tell you the institutions are in there or not in there. Presently, you rely on NASDAQ level 3 book view for institutional bids and asks. Yeah, but you see, the thing was, when you're looking at that, that's like level 2, level 3, but you're not seeing what's happening over multiple time frames. This is the problem with just looking at a current time frame for institutional involvement. Institutional involvement isn't a one time frame thing. It's looking at, you have to look across multiple time frames to see what they're doing. Because you could get a bunch of institutions that are selling right now in a 5-minute, but everything else is bullish, and then it goes back to bullish on the 5-minute. Then you can be back in because you've known all along that the multiple time frames they were still bullish. You know, which was, we use the 5, the 15, and the 45 on the 5-minute chart, and the 1 day, 3 day, 9 day on the daily chart. Okay, so that's the strategies we use. Again, straight calls, puts, debit spreads, time spreads, weekly ATMs, credit spreads to capture premium. That's the